This is Somi Vijay. Um, Today we're going to be talking about some of the biggest risks that we face today as investors in the investment community and being a part of the capital markets. Um, right? Some of the biggest risks, biggest challenges that we face today. Number one issue that I think everyone is talking about is the sort of geopolitical tensions. And uh, a lot of this is down to, I can say, deglobalization or protectionism, or we can call it, um, you know, a sort of a protectionist kind of an environment in which the US is getting into. And accordingly, when one country gets into that sort of a move, there will be similar impacts in various other countries. But what we have to understand underneath these sort of geopolitical tensions is that it leads to supply chain disruptions, which is quite possible in this kind of a case. We have built basically as a globalized economy. What we have done is we have built dependencies on each other's supply chains, and that is under stress currently. So more recently, we saw things around the chip shortages. We were discussing about what happens and what's likely to happen in the oil markets. Uh, some of the biggest uh, tech firms and their investments, etc. What is going to happen, with respect to these, um, right? So when we look at how things are shaping up, we're getting into um, a situation where we would consider a business with local supply chains to be relatively lower risk than those with globalized supply chains, right? We are getting back into maybe a 1970s, 1980s, 1970s rather, before I was born. Like that sort of a situation really, because all the way through my adult life, we have seen businesses trying to embrace globalization, bring in pretty much of a global supply chain. We are moving towards a sort of a say a protectionist shift. But then, what we also have to understand is that underneath these changes, there is basically one side is essentially a wealth redistribution that will take place because those who are able to control these supply chains and those who are able to control and make best benefit out of this. I think going back to my earlier discussion, I think a couple of weeks ago, we talked about the perverse incentives and policies, unintended consequences. No policymaker intends to create policies that are favoring the few. But what happens is some private parties will benefit out of that way more than everybody else. These geopolitical tensions give that opportunity to certain parties who can kind of make use of that. I think the biggest threat here is the threat to democracy. And one of the reasons why we've all been able to make reasonable returns on our investments is because we've had pretty much of a stable democratic environment almost everywhere, right? And with that, uh, we also need to look at how inflation is playing out in this sort of current environment. Uh, Whenever there is increased geopolitical tensions, protectionism, etc., there is likely to be a bounce back in inflation. And the moment you hear a bounce back in inflation, people's thinking goes directly to the central bank, um, interest rate related, um, interventions that the central banks need to do. Fortunately, monetary policy is a ineffective instrument when it is used to control inflation very specifically. This can this takes very long in order for it to show some benefit in the mainstream. And the reason why I say that is past experience, post 2008, kind of a low interest rate regime, how long it took for it to kind of take effect. The best interventions really come from fiscal policy. Do we need to raise taxes? Possibility. We need uh, to look at more targeted sort of benefit system? Possibly. And then we also need to look at this in context with the debt levels that we have around the world, right? Um, both the public debt, uh, and again I say government debt, is not to be confused as debt itself because it is more of a mechanism for us to save with the government. So don't see government securities or guilds as debt itself. See that more as a opportunity for you to save with the government. But then there are limits to it, right? Every time there are increased uh, levels of debt, there is obviously um, a significant risk that interest rates will go up. It will make it, basically a situation where it will make it more expensive, both for governments as well as businesses to borrow more, refinance, and it limits capital investment into the areas where it is most required. The UK needs infrastructure investment. So with that, it can basically reduce the chances of that capital investment being made. Uh, while we say that, I think what we also have to look at is over the last um, 2 quarters, really, we have seen slowing down in pretty much the global growth. When I say that, I'm particularly looking at um, how the asset markets are playing, how the if you look at the stock market performance, it has pretty much, I can say, uh, I can't say the word peaked out because most of the heated up performance is really from tech stocks, right? So if you basically look at it, just take the S&P 500 for instance. Take the S&P 500, dissect it, look at which stocks are performing and which ones are at basically the P multiples, etc. Uh, across tech, you see significantly high P multiples, which are not sustainable, right? But for a vast majority of the S&P 500 stocks, it is manageable. So where are you investing in? That is definitely a question. And again, on the question of economic slowdown or recession, here in the UK, we are seeing the signs of recession. Unemployment rate 4.7% as of today. Is it bad? No, I don't think it's bad. We've seen much worse. But is it something that is manageable in the sort of current situation? I think the biggest hit that we are seeing today is youth unemployment. And again, I keep stressing on this particular factor because uh, if there is one big risk for all of us, it's essentially not investing in the future. And again, when I say not investing in the future, it is basically the future generations very specifically. If you're not investing uh, in in essentially the younger generations, I think that is the biggest investment risk that we are making. We are more tied to the status quo versus the future. And when I say that with hand on the heart, because the fact that our pensions need to be paid, our NHS needs to be free, legally free at least. Our benefits need to be available when we are older, etc., etc. Um, there are there are various implications that we have, both financial cost of living, financial stability, etc., that we have, which depends on the younger generation going into reasonable work, wherein they pay their taxes, they pay their national insurance. If they are going into more of informal work, that affects us as the older generations. Right? I'm 50 right now. I'm going to be 50 rather just December, but I'm 50, and as I become older, I need to make sure that my child goes into a job full time by the time he is and I completes uni, etc. He basically gets into a job and he starts paying taxes and national insurance because that is my ultimate security later on, right? That is the reality today. But what we have got today is policies that favor the older generations versus the younger generations. And the youth unemployment is our biggest risk. Unemployment and underemployment. I want to club that together. Underemployment is not tracked by the ONS. It is not tracked by most other data sources. But we know for sure that nearly 20 to 25% of the under 30 population is underemployed. And that is a big number, right? So when I say underemployed, it means they're not at the capacity that they must be in, right? Uh, from a from a tech perspective, I think I touched upon the fact that tech stocks are overheated, and that's one of the biggest risks out there. But then with that, I also want to talk about two things very specifically here as biggest risk, biggest investment risk. One is an over dependence on AI, right? Every business wants to do something related to AI. Fantastic. You want to go into it. You want to trust this. But but look at how the AI market is investing. Most of the investment is going into infrastructure, data centers, power. Uh, so it is really at a stage where it was, basically the dot com 99, 2000 kind of a stage where infrastructure investments were being made. And then I say that also by backing up with, just looking at the biggest AI company, OpenAI, right? Their biggest competitor, Claude, has 1/10 of the number of users as OpenAI. That is this big mix. Okay, so they are the leaders. So you might get that message that they are the leaders. But then take a deeper look at the data that's been reported by OpenAI. Look at how many people convert into a paid plan. You'll be shocked hearing this. If you've had any sort of uh, tech product kind of experience, etc., you'll be shocked to hear this. Less than 2%. So that product, even though it's been in the market for 3 years, it does not have a product market fit. Really, it doesn't. So it's more of a billions in funding that is basically letting you use those servers, and somebody's still paying for it. As long as that party goes on, you will continue to do this. But when it stops, your reliance on these open AI model that I'm using, I'm going to build a business on basis of that. That is your biggest risk, right? The the all the other investments into AI that are going in are into building a data center, power for this particular thing, network connectivity for uh, UK data centers. I have a project on that I'd like to talk about later on, basically for a set of data centers. But Those are the areas that are there. And the second one, I wouldn't talk crypto really. And the reason why I wouldn't do that is because it's still insignificant, but it is growing in significance. But in the past, we saw with Trump, trumping it up literally and etc. etc. But then really the fact is, uh, can we let money creation fall into the hands of a select few people? That really is the risk that we must be thinking about. It's not like, it's some other financial instrument. It'll give me so much of returns, etc., etc. Okay, great. It is speculative in nature. But then really what you're trying to do is you're trying to create a replacement for the pound, for the dollar, for do you really want to give that away to billionaires? And uh, right now what happens is the pound is tied to the UK government. You elect the UK government. It's a democratic process. Like it or not, you might want to call it, nah, it's unfair, whatever, right? That's a different story. But the reality is you elect it. You elect the government. The government has ultimate control over the pound. Do you want to give that away to a billionaire who can screw you in the process? That's the question to ask when you think Bitcoin or when you think, what is that thing called, the stable coins, etc., etc. When you think about it, think, do I want to give that control to somebody else? Right? That's largely, uh, what you need to look at. There are a number of underlying factors that kind of contribute to all of this. Today, um, half the global population is under the age of 30. Tech savvy, digitally native, uh, and expecting digitally connected services, etc. So means the demand on all this is going to increase, right? But with that, what we also have is we have pretty much of a evolving legal and regulatory stance around the world, not just in the UK, that we clearly don't know how to regulate some of the newer technologies. Will we figure that out really quick? I don't think so. Right. And that again means that if you're an investor investing into these new buzzwords, be careful about it. Right. Understand this really, really well before you put your money in there. Uh, and this is something that's quite blatantly obvious. The sort of financial implications of climate change and environmental uh, deterioration is becoming more and more evident. You like it or not, you want to be a Trump supporter. You want to, yeah, it can always be that. But the reality is, you're seeing, at least here in the UK, you're seeing more of the extreme weather events, uh, which are not just, like I had a little bit more of rain today. It's not that. Those extreme weather events are disrupting supply chains. Prices are going up because of that. You do have situations where certain areas are flooded, etc., etc., and inaccessible. You are seeing that quite a bit. And then you might come back and say, we've had that for 80 years. Right. For 80 years, yes, it happened once in 10 years. Today it happens thrice a year. That's the difference that um, you need to be aware of. And uh, and and one of the things uh, that is being talked about in relation to this is we need to reduce the regulations. We need to build more homes. We need to do this. We need fantastic. But those regulations that are there, the green belt norms and the environmental protection measures that are there, etc. At least here in the UK, I can definitely talk about that. The various measures that are there, those were created with you or I in mind, not the billionaires in mind, right? So if you want to, hold up a placard and say, "Help the billionaires, take away all the regulations," it's your choice. But think about it, it is there to protect you. And if you think it's taking too long to get things done, yeah, there is always opportunities to speed up the process. But reducing regulation, making it uh, a free run is not the solution. Having the right framework is the solution. So, with that, I'd like to talk about three opportunities here. Number one that I want to basically focus on is the opportunities to create or rather invest in uh, strategies that will protect you from the downside risk. So today, the biggest downside risk that you have on the S&P 500 on the public markets is the tech stocks. They have some of them have very high drawdowns, so you are exposed to that. And with that, obviously, you'll have to be aware of the fact that the basically the drawdowns on your public market investments can be quite high. So, are there opportunities for you to reduce the drawdown, bring that more in line with broad market rather than a skewed index, right? So that is something to basically to look at. And the reason why I say skewed index is S&P 500 is a market cap weighted index. And with the market cap weighted index, what happens is as the market cap of some companies become larger and larger, the allocation for that stock becomes bigger and bigger. And just take a look at the data for the S&P 500. You will know that the biggest tech companies have the largest market cap, and with that, more and more allocation goes there. Right? It's a case of one leading to the other, which is something to be aware of. So, is there an opportunity to reduce that drawdown? Number two, look at how am I investing for the future? Am I investing in the status quo or am I investing for the future? And when I say future, think about the younger generations. They are the reason why you will get paid a pension. And if you're not investing in them, then your pension isn't guaranteed, right? So they have to be in profitable work. They have to be in work that pays them well, and it basically leads to income taxes and national insurance being paid. So that is your uh, real opportunity there. And on top of it, investing in products and services that the younger generation wants. It's a very big market, right? When we did a study, we based it on the study in coordination with the University of Edinburgh, uh, who provides us with a psychographic analysis every quarter. We find that nearly half the UK GDP is influenced by the younger generations in some way or the other, right? Either they are spending or they are working. It goes all the way from childcare to their uh, their employment to their expenditure, their investments, etc., etc. So think about that. Also the third opportunity to kind of look at is uh, can we build a sustainable and profitable portfolio, right? Is that possible, right? The answer is yes. The answer is a clear yes. You can find stocks of companies that are highly sustainable and profitable. You can build portfolios of those. You can invest in them. There are a number of trends to look at. In my second book, I talk about 15 different trends, right? There are many more. I know of 15, there could be 150 more. But uh, each of these can be used. So one of the things that I don't want to do is to come around and say, here are five five different things, go and invest in this. That would become financial advice. We're not authorized to do that. That's not something that we do. But this is more of a live session where we talk about the opportunities that we find and how it has worked for us. And again, on our fund, we identify these opportunities and we invest in them. Last year, we delivered 84%. This year, we are 65% up, likely to end the financial year at about 80%, 85% easily. Is there an opportunity? Yes, the opportunity is there. I know many people who invest in these trends uh, who get anywhere between 5, 7, 10% at a maximum above above the market. So we are talking anywhere up to about 20% annual returns by themselves, investing in their ISA and whatever, right? Uh, so is it possible? It's possible. Is it something that is right for you? You need to think about that. Please take financial advice with respect to this. If you're interested in our fund, just go to our website, helix.earth. There's a profile form that's available. Just fill in your details, and then we can get in touch. Right? Thank you. There are a number of deals that we have in the pipeline. We'll be talking about those in the next few days. There will be post on the newsletter about some of the deals and also the investor club that we are putting together. Thank you so much for watching. If you have any questions, this chat stream is going to be open throughout the day. So feel free to send in your questions or just message me as well. Thank you.